I think we're just starting this this next run, and it's going to build pretty fast. Because I don't think it's just overcoming a couple months of anxiety. I think it's also overcoming basically 3.5 years going back to October, almost 4 years now, going back to October 2022. You're at that point now where I think a lot of those that have had one foot out the door have brought that foot back in, and at least are beginning to bring that foot back in, and are you're about to see, I think, of a united bullish front here, which we haven't had for all that time. We've climbed a wall of worry.
David, not to give away your secret sauce, I'm sure it's a complexity of various things that you look at. I don't know, people seem to like things in threes. Maybe what are three indicators, employment rates, whatever it may be, that you look at that you think are important that form a lot of your views?
Yeah, as I said, sentiment is huge for me. So it's, I don't have any favorite sentiment indicator, but I look at, several, and you can get a pretty good sense, even on my feed, of where people are sentiment wise. Because, I mean, just a week ago, I was an idiot. And now, I'm getting people saying, well, you're right. Well, but, a week, I had somebody private message me and say he was writing some kind of a letter, investment letter or something, and I was going to be the feature of it as a fraud. He just thought my whole viewpoint is stupid and fraudulent. So it just amazing. That's the sentiment that was out there just a few days ago, and now all of a sudden you're getting people jumping on the bandwagon. So it's changing fast. Sentiment is a big one. I'll rather than, because I'm not really into. I look at trends, so it's not so much what's the data point that's going to turn this or anything like that. The trends are healthy, industrials look good, all of that. As I say to people in more generalities, my analysis includes technical analysis, fundamental analysis, macro analysis, sentiment, and cross-market analysis. By that, I mean I look at, for instance, months ago, I saw the coming financial move where the financial stocks were starting to technically look very good, and materials now also, and copper and things like that. So it was very hard for me to get caught up in, because I'm talking about a recession coming. I go, but I see too many good things out there telling me it's not yet. That may come in, faster than we realize. But right now, what I'm seeing is a broadening market. And I'm saying right now, 3 months ago, when everybody was talking about too narrow a market and worrying about Iran, et cetera, I was looking at a market that had, a lot of laggards that were starting to pick up speed and starting to look like they had long runs ahead of them. It was hard for me to even begin to get bearish when I've got that kind of stuff to look at. So that's how that's how my work kind of works. It's less about quantitative, let's sit down and compare, PEs or that kind of stuff. I was a value manager prior to being a strategist. So I look at PE multiples, I look at, all of that stuff, but basically it's more of the top down big stuff.
Okay, we promised we would come to the 25-year-old Leopold Aschenbrenner, situational awareness. Woo, 45 billion at 400% leverage, up 439% until a point last week that it wasn't. Lost 67% in a single month, sold, I guess, the public book to Citadel at obviously a discount the week of his wedding. Is this the long-term capital management, the LTCM of this AI era?
I don't know if it's that. It certainly marked the bottom for this cycle, I believe, anyway, for this correction, this consolidation. And it gave you, I think part of the reason we're seeing the reversal here is it really put an exclamation point on what really was behind the sell-off in semis, what was behind the sell-off in the Mag 7, and what was a sell-off in AI in general. Once it became clear it was this one guy, and that he had just taken a way too big a bite with leverage, and then found out that he had basically unwound it all and was out of it completely. I think it cleared the air so much for those that were fearful, worried that we were at a top. Once they saw that that was what happened, and saw that the market held in spite of that,
Yeah.
it really gave, I think, kind of a vote of confidence to the market for a lot of people who weren't so sure. And that's why I think we're just starting this next run, and it's going to build pretty fast. Because I don't think it's just overcoming a couple months of anxiety. I think it's also overcoming basically 3.5 years, going back to October, almost 4 years now, going back to October 2022. You're at that point now where I think a lot of those that have had one foot out the door have brought that foot back in, or at least are beginning to bring that foot back in, and are you're about to see, I think, of a united bullish front here, which we haven't had for all that time. We've climbed a wall of worry. Now, ultimately, it'll be troublesome because that wall of worry is going to go away. But I think as I tell people, I'm a contrarian, but I recognize very well from 53 years of doing this, there are times, big, lengthy periods of time, when the consensus is right. And we're about to see the consensus jump on this bandwagon and be bullish. So I think it's, I get accused of sounding too consensus when I'm a contrarian, and I go, yeah, that's because the consensus is about to be right.
Staying on Aschenbrenner a little bit, Kramer says that forced selling is a clearing event, I believe is what he said, a bottom. Clearing event or first domino, but it probably can't be both.
No, I think it's kind of are you talking about longer or shorter term, right? And I think in this case, for this period of time, it is definitely a clearing event. I mean, you saw it in the move we've had the last few days. You see it in the charts. You see it in how, what got taken to the cleaners. It was a clearing event. He's absolutely right about that. From a long-term standpoint, did it clear the leverage? And it's the tip of the iceberg in terms of the overall leverage in the system. But this was a case of a 24-year-old guy who had a lot of success playing momentum, but didn't have the years of experience or hadn't been through a cycle to understand how that leverage can really take you down as well as build you up. And he just it'll probably help him going forward to be a better investor, because he just got his head handed to him. Fortunately, he made a lot of money and still has a pretty good chunk. But boy, he lost a lot of money from inexperience, is what I'd say. And
Sure.
it's amazing. Markets are a humbling thing. There's not a successful investor that I know of in the history of this business who hasn't been humbled by the market. It's part of the learning experience that makes you a better investor. As I say, what separates good investors from bad is that the good investors learn from their mistakes. The bad investors just keep repeating them every cycle.
His thesis was arguably correct, and the fund, well, still died is too strong of a word. He has some great private holdings and still has billions, but let's go with it. What's the lesson? That's the more important part of this. What's the lesson for every family office holding levered AI exposure today?
Yeah, well, the cows are out of the barn, at least in the short run. I wouldn't learn from that lesson too quickly, but it is a longer term lesson that I'm sure many of the family offices and certainly hedge funds know, is that leverage works both ways, and it certainly can punish you pretty badly on the way down. And so I think that's the key lesson. I talk to retail a lot. I mean, I retired in 2013 and joined X soon after that, because I said this is a hobby for me as much as it is a vocation. It's an avocation. So I decided I could help the retail public by being on there and kind of teaching a more contrarian message about, trying to get them to learn not to pay as much attention to the short-term noise and the CNBC crowd and et cetera, and understand markets a little better than that and not get caught up in the tape, as I call it. And so, something like this is kind of what I've been preaching. I said to a lot of people, because I get blamed for people's losses. They'll go, "Well, you were bullish." So I said, these are cycle forecasts. I'm not a trader. I'm not telling you what's going to happen in the next 3 months. These are cycle forecasts. And but what I would tell people is, if you're playing options, or you're very margined, you're going to have periods where the market goes against you, and you may be taken out of the game. Whereas if you are an investor, what I'm forecasting, you should be fine. You just ride through. You ride through those consolidations. But what I see a lot is, it's the whole greed and fear thing. This guy just got a little too greedy.
Maybe last question on Aschenbrenner. The Collisons, those are the founders of the giant private company Stripe. Nat Friedman, Jane Street Money, billions wired to a kid, I guess to me, a kid who's never traded. Very smart. I wish him the best. And I think he will be a figurehead moving forward, but never traded. Why does mania, again, the more important part of my question, why does mania make smart money sometimes the dumbest in the room?
Yeah, it's amazing. Again, you're talking to somebody who put so much, I spent my whole career looking at sentiment. And I can tell you, behavioral economics, how investors behave, is probably 75% of the game. I mean, it's just amazing. You can talk to the biggest institutions out there, or all the talking heads that want to come on CNBC and give their opinions. For the most part, the majority of them will have rationales for their opinions, right? For their forecasts. By and large, if you really track it, and I have for many years, not scientifically anyway, but just watching it, they're being driven by the tape. Just like they were negative a week ago or 2 weeks ago, those same people now are jumping on the bandwagon and giving you a rationale why things have changed and why they're bullish. What changed? What changed was the tape. And I use the term tape for the market. And so it's the same thing, I'm sure, with prime brokers. The success that he had drove more belief. Early on, they probably said, "Oh, this guy's wet behind the ears. We got to be careful with him." But as he started becoming probably the most successful hedge fund manager out there, they started believing, because he was showing results that were through the roof. And so you start little by little getting drawn into that. And by the end, you're a full believer. This guy's, he can walk on water. He knows what he's doing. They didn't stop and realize what he was doing was playing tremendous momentum, and that momentum reverses just as fast as it goes up, maybe faster.